Paying off your mortgage early feels responsible. But for entrepreneurs in 2026, it's quietly becoming one of the biggest wealth killers in America. And here's the real danger. And nobody talks about this. Every extra dollar you send into your mortgage increases your risk of a liquidity blackout. What's that? Well, a liquidity blackout is when your business slows, taxes come due, opportunities appear, cash flow tightens, or expenses spike. And then you suddenly realize all your money is trapped in your house, and the bank won't give it back unless you prove you don't need it. Entrepreneurs don't lose because of that. They lose because of illiquidity at the wrong moment. And today, I'm going to run the exact math showing what a 42-year-old entrepreneur loses by sending extra $2,500 a month to pay off his mortgage early versus redirecting that same money into a tax-free compounding strategy with liquidity, control, and guaranteed 0% market floor. By the end of this video, the numbers will flip your mindset forever. Hello, my name is Robert Balgach. I'm the founder and CEO of Black Swan Insurance Group. And since 2017, we've helped over 20,000 families with 800 plus 5-star Google reviews build tax-efficient wealth using structures protected by IRS code 7702. Not Wall Street, not volatility, and definitely not bank permission slips. And if at any point during this video you think, why has no one ever shown me this math before? You can click on the link below and can book a free tax-free strategy session with me and my team. Now let's dive into Daniel's story, because his experience is the blueprint for thousands of small business owners navigating 2026. Meet Daniel, a 42-year-old independent mortgage broker in Denver. He's been in the industry for 18 years. He literally built his business from scratch. He survived the 2008 collapse, thrived during the refi boom, and then grew massively during the low-rate era of 2020-2021. But by 2026, interest rates stayed painfully high, and his once steady pipeline turned into a monthly guessing game. One month he closed 8 loans, the next month 1. Buyers hesitated, realtors tightened, refis disappeared, taxes kept climbing, and Daniel wasn't failing, but for the first time in a decade, he felt vulnerable. So he did what feels emotionally safe. He starts sending an extra $2,500 a month toward his $540,000 mortgage at 3.25%. He felt responsible, he felt adult, he felt like control, but it wasn't control, it was confinement. And when Daniel finally saw the math, he realized he wasn't paying toward freedom, he was paying toward a liquidity blackout. So let's walk through the exact math together, because this is where the story flips. The illiquidity trap. Entrepreneurs don't go broke because they run out of income. They go broke because they run out of liquidity. And Daniel's $2,500 a month decision felt smart until he saw the numbers. Over 10 years, Daniel sends $300,000 extra into his mortgage payment. What does he get? A lower balance, a faster payoff, but $0 he can use. 0 tax benefits, 0 compounding, 0 flexibility. And this is where the real danger hides. The IRS doesn't care how much equity you have. They care how much liquidity you have. So if Daniel needs money for taxes or payroll or opportunities, emergencies, estimated tax payments, he cannot access a single dollar of the extra payments without a bank approval process. That's not wealth. That's a self-imposed liquidity principle. In this scenario, he will pay off the loan around 10 years earlier, in roughly 12 and a half years, and he will save $193,000 in interest. But his liquidity still stays at 0. And here's where the math gets really shocking, because redirecting the same $2,500 a month into a tax-free compounding structure completely changes Daniel's trajectory. So let's compare the two side by side. And I'm warning you, this is the moment when entrepreneurs realize paying off the house early has been costing them 6 or 7 figures. So here are the assumptions. Daniel is age 42. He's contributing $2,500 a month, $30,000 a year into a max-funded IUL designed to stay non-MEC. I'm assuming 6% net credited growth, a after all the fees, 0% floor, no market downside, and tax-free access via policy loans. So after 12 years of a contribution, Daniel is expected to accumulate somewhere between $405,000 and $458,000 in cash value. At age 65, he is now in position to take $89,000 per year in tax-free annual income from the policy. And the key insight is very simple. Daniel avoids paying 3.25% interest, but loses the ability to earn a net 6% tax-free and compounding. That's a 275 basis point swing in the opportunity cost. And now here's the metaphor that crystallizes the entire concept. Think of your mortgage as a concrete silo. Money goes in, but nothing grows, nothing moves. And you can't really get it back when you need it. Your IUL is a greenhouse. It's warm, protected, growing year-round. It's accessible, it's nurtured, it's always producing more than you put in. A silo stores, a greenhouse multiplies. So which one do you think is better to build wealth? Now let's zoom out, because long-term compounding is where the real wealth gap explodes. And being debt-free feels good, but being liquid, tax-efficient, and compounding, that feels wealthy. So here's a 20-year comparison using the same dollars. On the mortgage prepay path, $600,000 of extra payments, $600,000 of built equity, zero liquidity, IUL path at 6% net, $600,000 contributed, over $900,000 in cash value after 20 years, tax-free access, downside protection at 0% floor, and legacy benefit at $1.7 million. So you're not choosing between debt-free and not debt-free. You're choosing between debt equity versus living well, between controlled by banks or controlled by you, between zero liquidity and tax-free liquidity, and between saving interest and building long-term wealth. So here's the truth every high earner needs to hear in 2026. Paying off your mortgage early isn't a wealth strategy. It's a liquidity trap with a nice emotional wrap. And entrepreneurs don't win by eliminating wealth. They win by maximizing cash flow, liquidity, tax-free compounding. And a properly designed max-funded IUL, structured under IRS Code 7702, gives you tax-deferred growth, tax-free access via policy loans, a 0% floor, protecting you from market crashes, liquidity on your own terms, protection for your family, a long-term wealth engine, and a legacy benefit that could exceed 7 figures. So if you'd like to see what going from paying down the house to funding your freedom looks like with your numbers, your mortgage, your income, click on the link below and book a tax-free strategy session with me and my team, because your business builds income, but your IUL builds freedom. And remember, it's not what you earn, it's what you keep. Enjoy the ride.